This is Boomer Life on CL 650.
Welcome back to Boomer Life on CL 650. I'm Joanne Sutton. Today we're speaking with Jim Doyle, Senior Financial Consultant with Investors Group Financial Services, and we're looking at why starting a new year is a perfect time to reflect back and ask ourselves, are we where we want to be financially? So that's the question. Are you where you want to be financially? So, Jim, I understand that you would like to help people become interested and involved in orchestrating their financial outcomes. And part of that is working with investors that may have some doubt occasionally and may not be confident that they can actually affect change. But you're here to tell us that fixing a lot of this starts with something as simple as how you look at your budget. Is that right?
Absolutely. Now, did I mention that advised clients tend to have more wealth? How does the saying go? Even the longest journey starts with a single step. So here's 3 tips to help you stick with a budget. Number 1, gather your data. Whether you're single or part of a couple, what are your sources of income and how much are they? Then look at your expenses. And I'm going to say it this way if I can. If you spend it, it's an expense. From there, you can put your spending choices into perspective. If you, say, spend $300 a month on entertainment, you can set goals and make trade-offs as to your financial priorities.
Well, I don't know, Jim. That part seems like a pretty tall task for most of us. 3 simple things. Gather data, review your incomes and expenses, and finally, set and review your goals and financial priorities regularly.
Well, I have to agree. Now, whether it's a lack of knowledge or maybe lacking a little discipline, it really helps to understand your starting position financially and have a handle on your cash flow.
Well, discipline is a key there. It sounds like the more successful you can make your clients at this, well, maybe the more successful that you are. So what can we do now or say now to help our listeners educate themselves about overspending?
One task that sometimes works is to assign homework. Do some basic research on their own. Like most things, if you have time invested in details, you're more likely to take ownership of the outcome. Without a detailed record, it's easy to forget the budgeting conversation.
I think this exercise might be especially important for those living from paycheck to paycheck because it keeps them engaged and helps them stay focused on their budget. Do you sometimes ask clients to just sort of go away and then bring the completed detail to your next meeting, or do you make them do it right there?
No, I think it's really important to put a bit of time in it, and I think it's really valuable. Many of the people we work with can't remember all of their expenses, so by assigning them homework to look at their bank and credit card statements, they can have more detail as to the income and the expenses and some of the choices that they're making.
Right. So what if you can't get access to all of that detail, like when you're looking after a parent or a loved one and you don't know all of their pertinent information of what their spending is? If you've ever had to deal with a parent's finances, there's got to be a number of unknowns that you'll deal with. And it could be basically anything from magazine subscriptions to money they've lent to a needy neighbor or money spent on bad habits or hobbies. It could be anything.
I think the first thing I want to suggest is do what you can, okay? A little bit of effort goes a long ways. But one of the significant unknowns, is getting a realistic assessment of a parent's health issues, okay, and how it might progress or change, because it can help plan and determine what particular services or costs might be warranted. And I see a lot of this in my practice, and it really does affect the finances. Assessing long-term care needs is often easier said than done.
So it's not just addressing the current care costs that exist today, but those that could likely arrive in the future. What's the biggest favor you can do for your family in the future if you see this in your future?
I have to say, collect your financial paperwork so that someone else can find what they need. Poor records could mean family members aren't aware of assets or tax liabilities associated with those assets, or even insurance that could cover some or possibly all of the expenses.
So basically, what's the big risk if they haven't got all this information in order?
Well, I think one of the biggest ones is the tax thing. This one always bothers me. If you're redeeming assets to pay for care costs and you're, say, selling the worst performing asset, you could intentionally be hitting them with a tax bill. And I see it all the time. If you can't find someone's tax records, I could see why this could pose a problem. In the end, however, you might end up triggering bigger out-of-pocket bills.
Navigating the healthcare system when your parents or loved ones need additional care, well, this is a significant obligation. But what I'm also hearing is that investment and tax issues have ongoing needs as well that need to be looked after. So having good records, and if it's possible to discuss with the family to plan ahead, these would likely produce better outcomes.
For most families that we work with, a lot of this is new to them. Navigating the healthcare system isn't an easy task. And there could be a number of options, but there's also a myriad of rules. On the money side of things, it pays to have a game plan. And again, if you're redeeming assets to pay for care costs, just like we spoke of, it can be helpful to decide which assets to redeem in which order so as not to impact taxes, tax credits, something called clawback, or selling the wrong assets possibly at the wrong time.
So, Jim, do you have any suggestions for people who would like to see their money last a lifetime? Some basics?
This is tender, but with increased volatility these days, protecting your savings as you approach retirement with the goal of making it last as long as you do is like navigating between a rock and a hard place. In this low-growth, low-interest rate world, I'm inclined to suggest lowering expectations for investment returns going forward. If you've been hoping for 7 or 8%, I'd probably ask, what does 5 or 6% do for you?
Well, I hear you, but after this past year, I think many of us would be happy seeing 5 or 6% on our upcoming statements.
If you're just a few years in retirement or even a few years away, I think you still have time to adjust your plan. The key is to be flexible and willing to rethink some of the old rules.
Well, there's a good point. What do you mean by old rules?
If you consider a 65-year-old could likely still be around in, say, 20 or 30 years, and yes, I hear some of you saying, hey, that's not going to be me, but traditional wisdom suggests investing heavily in stocks while you're young and scaling back the equity portion of your portfolio as you near retirement.
Well, it makes sense to me, but I'm also sensing that you feel people could be messing this one up. Why is that?
I think what skews people's retirement asset allocation is their planning for the immediate future. Unless you have a terminal diagnosis, we could be talking about a person being around for another 20 or 30 years.
So what's the alternative?
I think most people think it's about gradually reducing your stock exposure as you age. Clients often tell me, I'd hate to take a big hit just as I was about to retire. I don't have the time to recover. As we look at a different strategy, though, I want to suggest you please consult a financial professional before implementing anything that we're talking about. I'm not going to suggest a strategy for everyone, but it could be worthy of having a look at. Imagine gradually reducing your equity allocation to, say, 30% at the point of retirement and then raising it in retirement to, say, 70%. The rationale? Day one of retirement is when you're most vulnerable to the risk of a bear market crippling your long-term growth of your portfolio. If you start with a low allocation to equities and the markets decline, you haven't taken a huge hit and can gradually add equities or stocks back with the expectation that share prices will rise. If the market does fine, of course, you'll have more capacity to take risk later.
Well, it sounds great in theory and certainly a different strategy.
As a financial planner, I want to suggest that the strategy you choose should depend on your goals, your circumstances, and risk tolerance. If you have a large portfolio and plan to leave money to your heirs, a more aggressive portfolio allocation later on can make sense for those who are comfortable with the additional risk. But here's the thing. Do the math. Ensure that your financial plan can help you explore your options.
So what else could a retiree do to make their money last a lifetime?
Well, I want to say this in a way that people might be able to remember it, okay? But set your spending rate and stick to it. Spending everything you make is not a good recipe for success. On the other hand, some people feel that the 4% rule is the standard. That is, a withdrawal rate which is likely to help you maintain your principal over time. The problems start when you try to adjust the payout to reflect increases for inflation over time.
Do you feel that's a good standard that people should consider using?
You know, I felt a lot more comfortable with it in the past, but the problem comes with using historical market returns. Back when I came into the industry in the late 80s, long-term bonds were paying somewhere around 6%. You just can't get that from safe bonds today.
Exactly. So what do you recommend?
Now, we know that no one investment rule applies to everyone. To tell the truth, I'm probably happier using an initial 3% withdrawal rate or less. If the withdrawals are too large early on, you run the risk of lowering your standard of living in the future or possibly running out of money.
Well, could people just save more before they retire?
They could, but I don't think upping the savings goal dramatically a few years away from retirement is probably realistic for most people. Postponing retirement for a few years or even working part-time or longer could be great options if you can do it.
Do you ever go a day, Jim, without talking about what some tips are for retirement?
Probably not.
Well, we started this brand new year, and today we're speaking with Jim Doyle, Senior Financial Consultant with Investors Group. And I think most of us want to start the new year on the right foot financially. If uncertainty is creeping in and you count yourself amongst those that are feeling a little apprehensive about your financial future, then I would like to encourage you to take that first step and give Jim a call. 604-682-5431. He also has a toll-free number, 1-800-665-7178. Did you know that people who follow a written financial plan express higher levels of confidence and satisfaction during down markets? Well, stay tuned. Jim offers some tips on essential conversations that you might be missing with your advisor. That's all coming up next on Boomer Life on CL 650.
Celebrating the baby boomer lifestyle. This is Boomer Life on CL 650.